I'm David. Welcome back to the show. Today, I want to talk about something that's counterintuitive in financial planning. What if I told you there was a way to give generously to causes you care about, lower your tax liability, and feel more fulfilled in the process? And if you're 70 and a half or older, this strategy could be one of the most powerful tools in your financial toolkit. It's called a Qualified Charitable Distribution, or a QCD. And today I'm going to walk you through how it works. We're going to show you a hypothetical client example, when it would fit, why it works, and why the act of giving, when done meaningfully, actually deepens your sense of purpose in retirement. So the first question that you may ask yourself, what is a QCD? All right, let's just start with the basics. A QCD, a Qualified Charitable Distribution, is a direct transfer of your money from your IRA to a qualified charity of your choice, without that money ever touching your hands and without counting it as taxable income. Here are the key rules. You have to be at least 70 and a half or older. That's when QCDs become available to you. The money goes directly from your IRA custodian to the charity of your choice. This is extremely important. You don't withdraw the money from your IRA and then write a check. Your custodian sends the money directly to the organization. So the annual limit is $108,000 per person. If you're married, both of you over 70 and a half, $216,000 that you can take advantage of the strategy. And here's another cool thing. It counts towards your required minimum distribution. You're required to take RMDs at age 73. A QCD satisfies that. And here's the big one. It's not taxable income. So if you have significant wealth in your IRAs, you're not going to spend it all. And let's say you have kids, but you don't want to make them uber rich, or if you don't have kids or direct beneficiaries, a QCD can help you have a more purposeful retirement as far as giving, and also reduce your tax burden over time. So while a normal IRA withdrawal could be fully taxable, a QCD bypasses that entirely. Now, here's what you might be thinking. David, doesn't a regular charitable donation give me a tax deduction anyway? Good question. And here's where this gets interesting. So here's the disconnect that most people face. Most people no longer itemize deductions. The standard deduction is so high now that itemizing doesn't make sense for the average person. So when you donate to charity, the traditional way, you don't actually get the tax benefit unless you're one of the minorities that actually itemizes. A QCD is different. It works whether you itemize or not. Here's why. A QCD directly reduces your adjusted gross income, or AGI. That AGI number is critical in retirement because it affects so much. It affects how much of your Social Security is taxable, whether you pay IRMA surcharges on your Medicare premiums, whether you're subject to net investment tax or other phase out or deductions or credits. So when you use a QCD, you're just not getting a charitable deduction, you're actually lowering your adjusted gross income, or AGI, which ripples through your entire tax picture. Now let's go through a hypothetical example to show you the impact of the QCDs. So here we have Tim and Tammy sample, hypothetical client example. They have about $3 million in IRAs and 401ks, $700,000 in an after tax, about $250,000 in savings. They're both retired. Their financial priorities, they want to minimize taxes. They want some investment planning, but they want to contribute to charity. They're not trying to make their kids rich, and they are charitably inclined. So I think that's one of the things, the goals for QCDs to fit, is that you're both charitably inclined and you're not trying to leave all of your wealth to kids, or maybe you don't have beneficiaries that you want to leave this money to. You can see their goals. They need about $100,000 a year in retirement, and they've got $110,000 coming to them through Social Security and pension income. Now, what you're going to notice here is that if Tim and Tammy don't do any tax planning, and again, we're looking at QCDs, so we'll show you the impact here in a minute, their RMDs in the next few years are going to move them up to $135,000 of extra distributions that they're forced to take. And what you'll notice, those RMDs go up annually, assuming your money grows. We also know that in the uniform lifetime table that the IRS publishes, they make you pull out more every single year. The question is, how will QCDs impact our RMDs? More importantly, does it have the ability to reduce our overall lifetime taxes? That's what we're going to show you next. So one of the value adds that we provide to individuals is, what is your lifetime taxes? So you can see if Tim and Tammy don't make any changes, do any tax planning, they're already 70 and a half, their RMDs are due in 3 years. You can see right here, they're in this low tax bracket for the next 3 years. And then once their RMDs hit, you can see they're stuck in a much higher tax bracket moving forward. In fact, their estimated lifetime taxes is about $1.5 million. So now we want to see the impact of applying QCDs, and will it reduce their lifetime tax burden. So let's kind of apply what we call a scenario. So what we're going to do is we're going to say, okay, what if they do QCDs at $75,000 a year? Is it going to move the needle on some tax savings? So what you're going to see here, for them starting at 70.5 to start doing combined QCDs of $75,000, this has the potential to reduce their lifetime tax bill about $622,000. Now, what you're also going to notice, it reduces their portfolio size at about $1.9 million, obviously because that money is no longer in their hands. They've donated it to charity. Still, in this circumstance, they're going to leave potentially over $4 million to beneficiaries of their trust or whatever. So in this example, they can have their cake and eat it too. They can reduce their overall tax burden and still leave their beneficiaries with significant wealth. Now, what if we said, well, let's donate the maximum, or let's donate their full RMD. Now you can see significant tax savings. By them donating their full RMD, which we'll show you here in a second, which is about $135,000 when they're 73, now you can see this has the potential to save them over $1.2 million in total taxes. That's a lot of money. Now, of course, it reduces your portfolio balance here in this situation around $3.5 million, but their number one primary concern isn't legacy. Sometimes a prospective client comes to us and says, hey, legacy planning is the most important. Maybe we wouldn't recommend QCDs. But for some people out there, doing Roth conversions, looking at QCDs has an overall benefit of tax savings while you're alive. So you can see in this example for Tim and Tammy Sample, where they were going to move up into a significantly higher tax bracket, doing some level of QCDs has the impact to reduce their taxable income and save them well over $1 million in taxes over their lifetime. So what that allows you to do, instead of taking $135,000 required minimum distribution from your IRA, if you took that $135,000 and donated it with a qualified charitable distribution, because you don't need that income, suddenly your Medicare costs go down, Social Security now is taxed much lower, and you keep more deductions and credits intact. The charity received the $135,000, but you reduced your adjusted gross income by that RMD amount, which generates savings across multiple parts of your tax returns. That's why QCDs work. They're efficient, they're elegant, and they benefit both you and the organization that you care about. But here's where this gets really interesting. A behavioral finance expert named Dr. Daniel Crosby made an observation about giving that I think is profound. And we'll include that interview in the show notes so that you can go back and watch it. Here's what Dr. Daniel J. Crosby said. The truth about giving is that it has to hurt a little bit for it to mean something. I think some people just donate to donate. But what Dr. Crosby has found through his research, that if the amount that you're going to donate hurts a little bit, it actually has more meaning and purpose for you. When you give something that costs you nothing, spare change, money you wouldn't have noticed missing, your brain registers it as transactional. You feel a little good maybe for a few minutes, then it fades. But when giving stretches you, when you feel the sacrifices a little bit, something different happens in your mind and your heart. Here's what the science shows. When you make a meaningful gift, when there's real sacrifice involved, your brain lights up in the reward pathways. You experience deeper gratification. You feel more connected to your values. It's just not about the tax benefit, it's about identity. When you give in a way that requires you to choose that gift over something else you could have spent that money on, you're reinforcing your sense of self. I am someone who prioritizes others, and that has a profound psychological benefit. Let me give you a contrast. You drop $5 into a tip jar, it feels okay. You forget about it in 5 minutes. Scenario number 2, you sponsored a child education, you make a $20,000 commitment that requires you to choose that over vacation or a car upgrade. Every time you think about it, you might feel the weight of that choice and the joy of knowing you just changed someone's life. The second one sticks with you. It shapes you how you see yourself. It deepens your sense of purpose. And here's the one thing, QCDs make meaningful giving easier because they're tax efficient. You're not losing money to taxes. The full amount goes to the cause, and you feel that sacrifice in a way that builds your sense of meaning. Okay, so let's bring this together practically. If you have significant IRA assets and you're charitably inclined, QCDs allow you to do something powerful. You give in a way that reduces your tax bill, again, by lowering your adjusted gross income, reduces your Medicare costs by keeping your income lower. You can avoid some of the Medicare surcharges. It satisfies your RMD requirement. The distribution counts, so you're forced to distribute the money anyway, Might as well give it to a cause you believe in. It sends the full amount of money to charity, no tax drag between you and the organization. And I think the most important thing, and Dr. Daniel J. Crosby agrees with this, is it creates deeper fulfillment because you're giving money meaningfully and you're not losing money to taxes. This is why we model this out for our clients in our planning software. We can show you scenarios. What if you take your RMD as a regular withdrawal versus what's your tax bill? And what does your adjusted gross income look like? Then we flip it. What if we blend in or take the same amount as a QCD instead? Now let's see your AGI, your Medicare cost, your Social Security taxes, the full picture. The difference can be tens of thousands of dollars per year in some cases. Yeah, again, if you're 70 and a half and older and you care about giving back, a qualified charitable distribution is probably worth exploring. It's not right for everyone. It depends upon your situation, but for charity-inclined individuals, it's hard to beat. You get to give generously, get a real tax benefit, satisfy your required minimum distributions, and you experience the deeper joy that comes from sacrifice and purpose. If you're wondering whether a QCD can be right for you, and you like to model this out to see what your taxes are going to be in retirement, what Medicare costs can be, you're going to pay higher taxes on Social Security, what that looks like with a giving strategy, we'd love to explore what that potentially looks for you. Once again, I'm David Aframi, co-founder and CEO of BAM Advisory Group. Thank you so much for watching another episode. We hope you find the information very valuable. If you're enjoying this content and want more content just like it, click the like and subscribe button. It also helps us get this show, our content, out in front of more people just like you so they can also get some of this financial education. And if you're wondering if you may have a tax problem, if you're not sure if you have a well-written financial plan, click on the scheduling link in the description to the show and schedule a 15-minute, no obligation, no cost phone call with one of our advisors to see how BAM Advisory Group can help you. You can also visit our website at www.bamadvisorygroup.com and also schedule a call with us as well. Thank you so much for watching. We'll see you on the next episode.